So my name is Niall Bohan. I'm the head of the Capital Markets Union unit in the European Commission in the department that deals with financial regulation. I'll explain a bit more in a moment pretty much what we do and why we have become interested in alternative finance and crowdfunding in particular. But I appreciate it's probably quite I'm probably one of the last people you'd expect to see speaking at an alternative finance conference coming from the institution I do. So I think it is worth just explaining a bit why we have come to this part of the business or part of the financial ecosystem, why it is so increasingly the focus of a lot of attention across the different member states. I think our approach is very different from the funding circle approach. My approach will be a more policy-driven macro perspective, particularly at the outset. But I will spend quite a bit of time explaining what is going on in the crowdfunding landscape across Europe and how member states are reacting to it through regulation. I think, but as a starting point, I would just like to explain that the reason that we and regulatory peers in the different member states are looking so carefully at alternative finances is a part of the need to respond to the weakness, the very painfully underscored weakness that emerged through the financial crisis of Europe's excessive dependency on bank loans as a source of funding for small business in particular. So that there's a real Achilles heel in the European economic system, financial system, which is the paucity of funding for particularly the high growth potential, the expansion phase companies, and it is really that consideration which has led us to try to think about ways in which we can help the financial system diversify and strengthen the sources of funding available to small business. So in good European Commission terms, we came up with this concept, as you see here, Capital Markets Union, which is a very clunky term for describing how we want to try to help to make European capital markets deeper and more efficient and strengthen and broaden the financial ecosystem. So I'll just very briefly talk about what I'm going to do today is give you a very short primer on that Capital Markets Union structural reform program. And then I'll spend most of the time talking about what is going on in crowdfunding across Europe. So very briefly, the Capital Markets Union Action Plan is it's a structural reform program which is really driven by this overarching objective of trying to wean European economy off its dependence on bank loans. I think this graph explains pretty much, underlines why we felt the need to invest in this project. This is the sort of graph which describes the lending by the bank system to non-financial corporates immediately prior to the crisis, where we were hitting annual growth rates of lending to corporates of close to 10%. And then the crisis struck and the oxygen supply was cut off and the economy went into a nosedive. And that pro-cyclicality of the bank lending and the absence of any alternative source of funding for the corporate sector, I think, exacerbated the downturn and the crisis. And we all know the consequences. We're still living with them today, unfortunately. It got to the point where 35% of small business loan applications, even in core countries like the Netherlands, were being declined because banks felt unable or to lend to sometimes very viable businesses, but their balance sheets were stressed. So in response to this situation, we have developed this structural reform program. It comprises 6 sort of different headings, and the first one is the one that I think is really at the heart of the whole project and is struck a chord, I think, with policymakers across Europe, which is to try to strengthen the funding escalator for small business through private debt, private equity in a first instance. The second chapter is very briefly to make it easier for medium-sized and larger companies to reduce the entry ticket when they're raising capital on public markets when they have a listing. We're trying to also boost the flow of funding from pension funds, life insurance sector, the patient capital to bring it back into infrastructure and other sources maybe of higher risk projects in the green finance area. We're trying to help banks, capital markets and banking system. It's not a zero-sum game. We can make capital markets work for banks by strengthening securitization, including, and that's what we've been trying to do with our securitization proposal, which is now unfortunately facing a delay in the European Parliament. But I think the proposal, the framework that is proposed there, is seen as a good platform for restarting this market. The fifth area is we've got to bring the retail investor capital back into play. We have to get it out from under mattresses and 0% deposit accounts. But in order to do that, we have to make it interesting for retail investors to put their money at risk in capital market-based investment by giving them some upside. And at the moment, we feel the distribution system in particular is taking too much out to make it interesting for retail investors to get involved with capital markets. And then there are some long-standing barriers to cross-border transaction securities law differences in insolvency, clearing and settlement frictions, which just make it more expensive to trade cross-border and is anathema in the context of trying to build an integrated capital market space. So that's CMU. I'll come back a bit to the focus that we have on startup and expansion firms. And this, I think, graph is meant to illustrate the difference between the US and Europe in terms of the funding of small business. And we're actually, I think, the key figure is actually missing. I'm sorry about that. But what we would normally see there is that the stock of US bank loans to US SMEs is about 0.5 billion euros, and it's triple that in Europe. 75% of the funding of European SMEs takes the form of bank loans, and I think that is kind of the killing statistic. I think European firms, small firms in particular, are not using equity capital. I think 1.4% of European companies reported the use of equity capital or sought to raise equity capital in the past 6 months. That's reported by the ECB SAFE survey. So there is this reflex of turning to the bank, using bank loans for working capital, and then is that bank able to service a demand for expansion finance, which may be not backed by physical collateral, maybe an intellectual property-driven business model, then they struggle. And they struggle right across the continent, even in countries where bank lending is strong, like Austria and Germany. Is this area of expansion finance that is weak. So we see here in the numbers I do have that Europe is lagging behind in all aspects of private equity, venture capital, crowdfunding, angel, family investments. Anything other than bank lending, we struggle and we fail to deliver. And that's highlighted again in this chart, which shows how big the gap in terms of percentage of GDP between Europe and the US. So our angel investment and our venture is falling a long way behind, lagging far behind the US counterpart. And you can see here a ranking of the countries. Sweden doing surprisingly well, UK not surprisingly in a very strong position, but then the other European countries, Germany, France, are laggards. And these are the stars. You've got to remember that 90% of European VC funding is invested in only 8 European member states. So there's a lot of VC desert out there. So in the CMU Action Plan, just to conclude, before we turn to crowdfunding, we have a number of measures that we will come forward with in the near future, and then the more more medium term, revisit venture capital legislation, use EU public support to boost VC, and try to encourage an intelligent tax treatment of the VC and private equity investments. So we see a strong focus on VC. And we're aware that VC has its weaknesses. 40% of the money in European VC is public sector money, and it has delivered 1.3% average return over the past 5 years, which is not stellar. But we believe that VC is part of this funding escalator that needs building. And we'll do some other worthy things, I think, in terms of trying to also borrow a bit from the UK experience in trying to help banks communicate with small business better. We're going to look at the UK Business Growth Fund, a very interesting model for a public sector type structure to help small business taking minority stakes in them. And as I said, we will be looking at the rules around public offer by simplifying prospectus. So turning to crowdfunding, which is, I imagine, your main area of interest, what I'll do is briefly talk about some of the developments across Europe. Now, the UK is a very exceptional market in this respect. You are very, very far ahead in the vanguard. And I think using the UK as a reference is in some respects misleading for the rest of Europe, which is really only setting out on this journey. So I think we need to bear that in mind, that crowdfunding has established itself here as part of the financial architecture, and that is only starting to develop in some of the other countries. But what we do see is a multiplication of platforms across Europe, over 500 of them, in 22 different member states. So we're getting a bit of a national champion effect, with every country has to have its own crowdfunding platform. Most of these platforms are UK-based. We count 143, then France with 77, Germany 65. A lot of this is reward-based crowdfunding platforms. The equity platforms constitute 23% of this number, and the loan-based crowdfunding 21%. So that's, and from here on out, I will focus principally on the financial return business. These are the results of a study done for us by CrowdServer, looking at data in 2013 and 14. It covers, as you see, 8% of the market, and 81% of equity and lending. And we saw that 2.3 billion euros was raised here in Europe, the lion's share here in the UK. And despite their sort of relatively small proportion of the absolute numbers, equity and loans are a large part of that. And as was remarked by the previous speaker, the last couple of years have seen just a phenomenal growth in the percentage growth rate in equity between 2013 and 14 of 167%, and loans of 112%. So this, I think, if you're starting from a low base, this kind of growth rate is to be to some extent expected, but it is eye-watering to some extent. One figure that is not here, and which I think is very interesting and is maybe a sign for the future, is the average amount of money being raised on the equity platforms. And here we have seen quite a strong change, especially in the past year. In 2014, the average amount raised was 260,000 for equity crowdfunding. And this compares, for loan funding, it's 11,000. It's a much smaller amount. That's our data. But what we've seen is this number is increasing very, very quickly between 2013 and 2014. And if we understand here in the UK, the data from Cambridge, UK Alternative Finance Report suggests that the average equity raise now in the UK is 525,000 UK pounds, which is it's big, suggesting maybe the institutionalization of the investor base here in this business, and also bringing us to a point where the amount of capital being raised is going to sort of, I think, attract attention in terms of authorities responsible for investor disclosures. But in passing, I will say in the new prospectus proposal, we have increased the threshold for the public offer prospectus to 10 million. So there in the case of a cross-border offer, with 10 million capital being raised, a prospectus will be necessary. Below that, it will be at the discretion of the member state. So we have created, we think, more space in our proposal for this kind of capital raising without the need for prospectuses, but that, I think, there isn't a large amount of discretion for the individual member states. In terms of cross-border capital raising, here you'll see just how small this is. This remains still a very local business. The equity loan capital, the funding of projects by a platform in one member state of projects in another is only in the order of 15 million, which is a mere 1% of the funds raised. So it's really marginal. However, this is the funding of projects on a cross-border basis. The amount of capital being raised cross-border, so investors coming to a platform in another member state, there is currently no reliable data. What we understand is that here in the UK, 12% of the money invested through UK platforms comes from other European member states. Our discussions with regulators and supervisors across the European Union suggest that their attitude is, unless the platform is tailoring the disclosures and actively soliciting business by talking about the tax treatment of the investment or making the disclosure available in the local language, then they would not consider it active solicitation and would consider the investor as moving offshore with their capital, in which case they are happy to proceed on the basis of a caveat emptor. But I think as soon as the platforms start actively soliciting business or capital raising, then that situation will change. Crowd investing, the regulatory landscape. So as I said at the start, other member states are coming to this recently, but what you're seeing is, following on the UK example, an attempt to try to get their heads around this business and respond. Regulators abhor a vacuum, as you will have observed, and crowd investing has attracted a lot of media attention and is a growing business. So they're starting to pick it up and look at it carefully. And I'll explain some of the sort of elements they have put in place in terms of local regulatory response. It is far too early to evaluate the outcome of any of these regimes, which have only been adopted in 2015 in many cases. But in the case of equity, what we're seeing is a couple of countries are licensing equity platforms within MiFID as doing investment advice or reception and transmission of orders. But they're a minority. We have 7 countries already counted who have developed a bespoke regime, and that includes the UK, of course, but many of the others have developed a customized regime outside MiFID because they're assuming that the investments are not transferable instruments, are not financial instruments within the meaning of MiFID. They're participations of one or other sort and not transferable. Or the services, to some extent, are exempt. They're using the MiFID exemption for some reception transmission services, or they're considering it just doesn't fit in the mold of MiFID, so they're developing a separate regime. What they all do, to some extent, is focus on the risks you would expect: business conduct, conflict of interest, organization, so some variation on minimum capital requirements, conflict of interest rules, and then clearly making sure the investor is apprised of the risks that they're taking in terms of putting their capital risk, making sure that they're aware of the system, the channel through which they're investing. In the terms of crowd lending, I find to some extent crowd lending harder. There's probably even more diversity in the business models in crowd lending because of the mix of payment systems, credit intermediation, debt collection, etc. So, it's even more difficult, I think, for a policymaker to decide, well, how do I fit this into a system which, for lending, is very much, and credit intermediation is very much shaped by thinking about the banks, the traditional bank structure. So I think that is a challenge, and what we see is that crowdfunding peer-to-peer does not fit easily under any of our, neatly into any of the regulatory boxes that we have at our disposal. Some of them have a payment institution license authorization on the European Payment Services Directive, and that kind of entitles them to then trade across border. Others have fallen back to the domestic bespoke regime, and others are using regular trading licenses for different brokerage services. It's a real mix. The risks here that they're focusing on are the credit analytics and the credit worthiness, so making sure the platform has done its homework on the platform, provides some disclosure, and then I think a feature of both peer-to-peer and equity is that some countries are imposing limits on the amount that any particular individual or lender can pledge to a particular project. And in the case of Germany, in the case of equity financing, there is a recent law when they have imposed very strict limits on the amount of capital that any particular retail or even institutional investor can put into play. And I think that is attracting a lot of criticism in Germany as something that could potentially be a showstopper in that jurisdiction. So that is, I think, very briefly the picture that I wanted to just briefly introduce. I'll explain in a minute where we will report all of this in more detail. But by way of conclusion, just some general thoughts. What we're seeing is a business that remains, I think, largely locally focused. Platforms serving projects in their locality, raising capital more or less in circuits that are known to them. And I think the UK is the first jurisdiction which is successful in achieving the scale and volume and the reputation around some of its platforms that can pull in capital from other jurisdictions. That local focus has led or allowed, I think, bespoke regimes to be developed by local regulators to respond to local circumstances and risks. Despite that, there is a certain general consistency in terms of the core risks that these systems are trying to address, focused heavily on protecting the investor. But that was, in a way, I think, the more sort of positive message. I think what we are seeing is clearly with this level of regulatory activity in the different member states and the differences in approach, of which the German approach to investor limits is one example. You have regulatory proliferation. You have very fundamental differences on when something is a MiFID service or not a MiFID service, even in respect of the same activity or business model. That then triggering different regulatory treatments. So ultimately, I think the risk is there that as platforms seek to hunt scale and volume across borders, that these regulatory kaleidoscope is going to prove challenging for the industry. At the moment, this remains more theoretical than observed, but I think it is something that we need to take note of. I think with the level of investment in regulatory systems by member states, then I think we need to be very, very attentive. The Commission's approach here is extremely, I think, benevolent towards the crowdfunding industry. We're fully aware this is risk capital. that people are putting into play, that investors are at risk of losing everything. That needs to be crystal clear at the outset. But we see it, as I said from the start, in terms of building the funding escalator. Crowdfunding is an incredibly important step, an element in the system. It's a sort of a missing link to some extent. It's the first chance through the equity platforms that small companies right from the off will be exposed to equity ownership and sharing control of companies. So I think that's the sort of driving or dominant position that we have. We are seeing these big differences across member states. We think policy experimentation that we're seeing is appropriate to allow the industry space to grow itself, and we're fully concerned that the premature regulation could hamper and get in the way of this healthy development. But as it gets to a stage where it is such an important part of the ecosystem, and we understand it accounts for 14% of SME lending now here in the UK, it gets a dimension which is going to attract attention from a stability perspective, from a microprudential investor protection perspective. So the last remark is that pretty much everything I've said here will be reported at the end of April with a lot of detail on the different regulatory regimes that I have touched on in a report we will publish at the end of April from the Commission. It describes the domestic regulatory and supervisory arrangements and gives the sense of the market. It provides a baseline for further close monitoring of the sector, but at the moment I think you can maybe sleep easy that the Commission is not planning any short-term intervention in the area of crowdfunding. We see our role is really doing what we can to help ease the transition and development of this business on a cross-border basis. So thank you.